Cash flow can make or break a construction project, and sometimes the biggest challenge isn't whether you earn the revenue, but when you actually get paid. That's where retainage comes in. Retainage is a common practice in construction contracts where a portion of the payment is held back until the project is substantially complete or until requirements are met. In many cases, that withheld amount is around 5 to 10% of the total contract value. From the project owner's perspective, retainage is a form of protection. It helps ensure the work is completed properly, punch list items are addressed, and contract obligations are fulfilled. But for contractors, retainage can create financial pressure. Think about it this way. Your team already performed the work and you paid for materials, covered labor, brought in subcontractors, and kept the project moving. But part of the cash tied to that work is still sitting out of reach. That timing gap can strain liquidity, especially if you're managing multiple projects at once. One project with retainage may be manageable. Several large projects with retainage can create a much bigger cash flow challenge. That's why retainage needs to be handled carefully in your accounting process. On the balance sheet, retainage receivables should be tracked separately. If the job is complete, retainage receivables are generally included with contract receivables. If the job is still in progress at the end of the reporting period, those amounts may be included as contract assets. On the income statement, retainage doesn't necessarily reduce the revenue you earned, but it does affect when cash comes in. So, even if your revenue looks strong, your cash flow statement may tell a different story. So how can contractors manage retainage more effectively? First, try to negotiate retainage terms before the contract is signed. It may be possible to request a lower retainage percentage, ask for retainage to be released in stages, or tie payments to specific project milestones instead of waiting until the very end. Second, track retainage receivables closely. Don't let them sit unnoticed in your accounting system. Maintain a detailed schedule showing how much is outstanding, which project it relates to, when it's expected to be released, and whether any follow-up is needed. Third, build retainage into your cash flow planning. Forecasting should account for the fact that some earned revenue won't be collected right away. This helps you spot potential shortfalls early and make smarter decisions about financing, staffing, and project timing. Fourth, consider creating a retainage reserve. Setting aside a portion of revenue can give your business a buffer when payments are delayed. That reserve can help cover operating costs without relying too heavily on credit lines or other outside financing. And finally, communicate early and often. Stay in contact with owners, general contractors, subcontractors, and suppliers so everyone understands expectations around payment timing, project completion, and any remaining work. With the right systems, planning, and communication, retainage becomes easier to manage.